All right, so welcome everybody to the Senior Managers and Certification Regime workshop. Today we have on our panel Polly James, who's with the law firm Bryan, Leighton, and Paisner. She is a partner involved in global investigations and financial regulations practice. And then we also have Tyrrell, who is with State Street, and he's head of compliance. And he's actually head of compliance for Europe, Middle East, and Africa. And he leads not only on compliance, but also has financial crime team responsibility across the business. Now, we also were supposed to have a gentleman from Barclays, but unfortunately, he's been called into a meeting with a meeting outside the business. So he unfortunately could not be here. But what we're going to do is, in terms of how we want to run the session today, we're going to assume that you all understand kind of the basics of the senior managers and certification regime. So we're not going to go through the details of the regulation, because I think what's more valuable for your time today out of the office is for you to be able to hear from Polly and also from Adam in terms of their own experiences. Adam's experience in terms of implementing the regime within State Street, and also Polly's experience in terms of supporting the financial industry in terms of ensuring that they're compliant with the regime. So with the Senior Managers and Certification Regime, as you may well know, it was designed to improve accountability and also drive a higher level of appropriate conduct with integrity across the financial markets. Now, Polly is going to start with giving us a context for how we got to this point. And then what we're going to do is follow with Adam kind of taking us through some of the things that he didn't expect to encounter when they implemented the senior managers regime that you should probably think about, because many of the buy-side firms have to comply by December of 2019. So these are some notes that you might want to take and understand his experience. And also Polly is going to share with you her experience in terms of working with the institutions. And then we're going to finish on probably the more challenging part of the senior managers and certification regime, which is developing that culture of governance that the regulator wants to see in the firm. So, Polly, you want to get us kicked off?
Thanks. Good morning, everyone. Can everyone hear me okay? Great. Just before we kick off, can I just check that everyone's happy with just the structure of the regime, with how it works? If not, then I can do a sort of 2-minute intro just to make sure that everyone starts off from the right place. Show of hands if anyone wants a quick 2-minute, what happens at each level? Perfect. Could we just draw a triangle on a piece of paper, really big triangle like that, and then draw 2 lines inside the triangle so that it's got 3 levels, a bit like that. So at the top level of the regime, you have SMFs, Senior Management Function Holders. And those people are the people who are doing the jobs that are most important to regulators. They have to be pre-approved by regulators to do those jobs. They also have to have a special regulatory job description called a Statement of Responsibility, which sets out exactly what they're responsible for opposite the regulators, and effectively gives the basis to the regulators if they want to bring enforcement action against that person later for not doing something properly. That's where they go to show that the person had the responsibility for doing that in the first place. There's also something called a duty of responsibility that falls on senior management function holders, and that says if something goes wrong in the area of the business that they are responsible for, then they can be disciplined by the regulator for effectively allowing that breach to happen, unless they have taken reasonable steps to prevent it from occurring. So that's the people at the top of the pyramid, senior management function holders. The middle piece of the triangle is certification staff. And what are they? That is the roles that are less important than senior management functions to the regulators, but are still roles where somebody in that role could cause significant harm either to the firm or to any of the firm's customers as a result of doing that role. So the regulators sometimes refer to them as significant harm staff, sometimes they refer to them as certification staff. It's the same thing. It's these people in the middle who are not senior, but they do have a role where they can cause an impact on the firm. And then the bottom, sorry, let me just tell you about the significance of being certification staff. Firms themselves, every year, have to assess the fitness and propriety of each of their certification staff to do their job. And if they're satisfied that they're fit and proper, they have to issue them a certificate that says, we are happy that this person is fit and proper to do role X. And if they are not satisfied that that person is fit and proper, then they are not allowed to keep them in that role. They have to redeploy them or fire them or whatever else they decide to do, and that causes consequences on the employment law side that I'm sure we'll come on to talk about in a moment. But certification staff, there is an annual requirement to have a certificate to show your fitness and propriety to do your job. And then the very bottom level of your pyramid, those people are referred to as conduct rules staff. And they are people who are not SMFs and they are not certification staff, but they are nevertheless subject to personal regulatory duties for the first time under the senior managers regime, under a set of new banking standards rules essentially called the conduct rules, which can be found in the regulator's handbook. And almost everybody in the organisation is now subject to conduct rules and therefore have personal regulatory duties opposite the regulator that they can be fined if they don't stick to. The only people who are outside the scope of the conduct rules are known as ancillary staff, and they are pure administrators, so your sort of reprographics assistants, your security people. They don't have personal regulatory duties under the conduct rules, but everybody else does. So
although I've always found that strange that the reprographic assistants often see some of the most sensitive stuff that may be going out to a client and may be price sensitive, and yet they're not covered by this. I always thought the best, if you want to do insider trading, the best person is to be someone in the print room or a cleaner. Yeah. Because they're the ones who are most likely to see something sensitive that no one's meant to see.
They could still actually be fined for being knowingly concerned in a breach by the firm if they are discovered to have known what was going on and not done anything about it. But the broad picture, as you'll probably see, is very, very much broader personal regulatory accountability under the senior managers and certification regime than there has ever been until this new regime came into force. And so we just wanted to spend a couple of minutes introducing the panel by explaining how is it that we've got here? Why are we suddenly in this place where personal regulatory accountability is so important and is so widespread within the regulated community? And I think if you look back to the sort of pre-2006 era, and I remember being on secondment to the FSA as it then was at this time, there was really no enforcement action going on against individuals unless they'd done something that was really obviously wrong, that the man in the street would look at and say, yeah, you can't do that. So unless you had your hand in the till or something of that ilk, really pre-2006, it was very unlikely to be pursued on an individual basis for a regulatory breach. That started to change, though, while I was there at the regulator in 2006. There was this new idea driven by a lady called Margaret Cole, who ran the enforcement division at the time, called credible deterrence. And the idea behind credible deterrence was that actually if you want to change behaviours within financial institutions, you can't just fine the institution, because where does that end? The shareholders have to pay a fine and the people who are in charge don't actually have any consequences. What you have to do if you want to change behaviour, she thought, is hit people in the pocket, is fine individuals large amounts of money, and that's how you're going to actually get people to stand up and take notice. So back in 2006, we were already seeing within the UK regulators a movement towards personal regulatory accountability, towards enforcing that, towards making people personally pay the cost of regulatory breaches. And the reason for telling you that is I think that actually the journey towards where we are today is a much longer journey than a lot of people realise. So yes, we then had the financial crisis in 2007, the Parliamentary Commission on Banking Standards, which was commissioned to try and figure out why that happened and how it could be prevented from happening again. Their report, Changing Banking for Good, in 2013 was the short-term catalyst for this regime. And that was what gave rise then to the Banking Reform Act in 2013, which changed the regulatory structure in the ways that we're describing today. It had a longer tail than that, though. Its roots, I think, are in the pre-financial crisis era. And really, it was the financial crisis that gave a political impetus to the change that was already happening. one of the key recommendations of the Parliamentary Commission on Banking Standards was that they said a more effective sanctions regime against individuals is essential for the restoration of of trust in banking. They called the approved persons regime, which was the previous regime in place, a complex and confused mess. They said it wasn't fit for purpose. They said that a better regime was required in order for regulators to be able to hold senior managers to account for regulatory failings in their firms. So really, at that point, the writing was on the wall, I think, for the approved persons regime. There was going to be a change. It started, of course, in the banking world, but it was announced by the Treasury in 2014 that it would be extended to all firms. That's taken a little longer than expected. It's being extended now to insurance companies this December and to all other authorised firms next December. But we were discussing this before the session, and I think while the UK has been seen in previous years as a bit of an outlier in this respect and this determination to hold individuals to account, that's no longer the case.
Yeah, yes. I mean, the CBI, which is the central bank in Ireland, released a paper on culture in their financial services industry. I think it was last month, and they're referring to creating a similar regime to this senior managers regime. So for those who are moving to Ireland or are already operating in Ireland or moving there as a result of Brexit or whatever, then you can expect something similar there. And in fact, I think in Asia there's a couple of regulators there in Hong Kong and Singapore who are looking at something similar.
Yep. So we're no longer total outliers. I think if you mention this stuff to regulated firms in the US, you still get some pretty horrified reactions. But certainly we're no longer standing on our own in saying that personal regulatory accountability is important, and certainly it feels as though it's not going to change. This is a direction of travel that's been firmly set, I suggest, since 2006, and since the Changing Banking for Good report. Really, that's just increased the momentum of something that was already happening. So that's where we are. It has a number of practical consequences, which there'll be plenty of time to talk about now, I think.
Yeah. So Adam, would you like to kick us off with what you've learned, what the firm's learned from this?
Yes, I guess I joined State Street after it had been implemented, but I am the sort of senior manager for the compliance function, so that's the SMF 16. And I think the key thing is, like all these things, there are some unintended consequences, and I'm probably not the expert on some of those. They sort of appear over time, and sort of they come out of the woodwork sometimes at the worst possible moment. But I think fundamentally, when you think about it, what the regulator was driving at here was getting the banks, forcing the banks to put in place what the reality is they should have had in place anyway, and that's sort of a proper governance structure, a clear sight of responsibilities and accountabilities. So for me, that's key, that the senior managers regime provides the organisation with a framework, but they need to take that framework and put their own governance structure in place that meets that framework. And so it's a guidebook, really. Now, clearly, they're forced to do it, but the reality is, for the most part, they should be doing it anyway. And so there, if you look at some of the challenges, what sort of formal governance do you have through committees, but balancing that with the fact that the one key thing I think the regulators really pulled out, which may be different from the past, is individual accountability. And so while you can have committees, the regulator clearly doesn't want management by committee for specific lines. They want somebody to be making the final decision, and so that, in the worst case scenario, they've got someone on the hook for that decision. So that's one of the big challenges, is how do you get that balance between having a formal committee structure but having the decision at the right level and accountability for those decisions. I think the other key area I see is that this statement of responsibility, that ultimately, even if you're responsible for something, you're not doing all of it. So you then have to figure out your delegation matrix, as we call it, and I think others call it, who you're going to delegate some of that responsibility to while still being accountable. And that forces a lot stronger structure around oversight and supervision of your teams. Again, completely appropriate. I think one of the challenges in the past is that it wasn't the people at the top of the house who were responsible directly for LIBOR and FX, but that banks couldn't demonstrate that those people at the top had the right supervision of the teams below, and hence, irrespective of whether the culture was right at the top, they weren't feeding that culture down and making sure that the decisions were being met that those senior people required them to make and going about things in the right way. So this level of supervision that's now required for you to demonstrate if you're going to delegate, as I do to my team, as the senior managers in the business do, is critical. I think the other thing that's specific to State Street and some other organisations, clearly with some of the UK banks, you've got a very broad, big organisation, and I think one of the challenges, not that I'm directly in a large UK bank, is how do you not end up with too many senior managers that you can manage, because it's such a broad organisation. How do you have one senior manager for compliance, one senior manager for a specific line of business in a very big legal entity? But for international banks like State Street, it's how do you get that balance when you're headquartered somewhere else to make sure that we've got accountability here and hence decision authority here for something that's really important to us, being the UK jurisdiction, the UK business. But then also coming back to the point about sort of the US regulators and people in the US maybe sort of staring blankly at some of this, why do you need this? That we do have senior managers who are outside the UK. And so there's a designation for that, for somebody who has senior oversight over a business or a function outside the UK, that if they still have that control effectively of that, then they get designated a senior manager. The UK regulator expects that. But do they understand really the sort of, the responsibilities of that, worst case scenario? If they didn't meet those duties and they travelled to the UK, they might not be leaving the UK. So those are three: the sort of the governance structure, the supervision, and then the fact that as an international bank with a base here, how do you get that right balance between still being part of a large group, which obviously has benefits, but having the appropriate oversight here to make sure that the senior managers here have the accountability they need.
So Alan, I would assume that even the senior managers that are in Boston, for example, for State Street, they have to get signed off by the FCA.
Yes.
Right, so they
Yes.
have to go through that approval
Yes.
process. Okay. All right. Anything else that you wanted to add?
I mean, those are the three main things. Yeah.
Okay, great. Polly.
So some perspectives, I guess, from a practitioner perspective, and I'm somebody who spends a lot of time either defending individuals who are on the wrong side of this regime because they've failed to manage something properly for whatever reason, and also I do a lot of work investigating allegations that have been brought often by whistleblowers within firms, and we'll talk about this more later, I'm sure, but I think one possible unintended consequence of this regime is that you do see a lot of whistleblowers because people are very anxious about their personal position opposite the regulator, and one way to protect your position is to call it out first. But in terms of, I could come up with a very long list of what I would see as unintended consequences of implementing this regime. If I picked three, because three is a good number, I would start with one that concerns certification staff, so that the middle chunk of our pyramid, and specifically a sort of operational unfairness that I'm observing in my practice about what happens to those people when there is some sort of investigation or some sort of cause to question whether their conduct has been up to standard. I'm contrasting here the position of the certification staff in the middle of the pyramid with the senior management function holders at the top of the pyramid. If you're a senior management function holder, and if you are under investigation either by a regulator or just internally for something that relates to your conduct or how you've managed your area of the business, typically you can stay in that role while that investigation concludes, and it's not unusual for a regulatory enforcement investigation to take 3 to 4 years. That's not a great place to be, obviously, but you are in a job, and you probably would find it difficult to move jobs at that point because you're going to have to make disclosures about the fact that you're under investigation to prospective new employees, but you are at least in a position where you can carry on in your role. It's a bit different though for the certification staff in the middle of the pyramid, and we have clients in my group where there is an investigation into somebody's performance or their conduct in the certification staff bracket, And the firm finds it very difficult if the investigation continues past the annual certification deadline to allow them to continue in role. The reason is that the firm's statutory duty under the amended legislative framework is to not certify somebody fit and proper unless they are satisfied that the person is fit and proper. And it's quite difficult when somebody's actively under investigation, particularly if there's a regulator investigating their behaviour, to say with confidence, yes, I'm satisfied that this person is fit and proper. It feels like quite a risky decision for an employer to take to certify somebody in those circumstances. And so what that gives rise to, in my view, is purely an unfairness, where the senior people whose conduct is being questioned get to carry on doing their job pending a negative outcome, but the middle management probably can't. If you don't get certified fit and proper to carry on in your role, you can't carry on in your role. You have to be redeployed. You probably can't move because you would have to disclose, or your firm would have to disclose under the regulatory references process that exists under this new regime, that there has been an issue. And so that just seems to be something that hasn't been properly thought through by the regulators, in an area where really there needs to be more specific regulatory guidance to firms on how you deal with this situation. What is the expectation? And specifically the senior manager who's responsible for operating the certification regime, because that does now have to be somebody specific who has that responsibility, needs to be able to get comfortable on the basis of specific guidance that the regulator is giving on what you do with those people. Otherwise, it just seems to me that that's an unfairness that can't be justified, that's hardwired into this new regime. My second unintended consequence I wanted to talk about is actually it's also about the certification staff. But it's also about senior managers and the appraisal process and the process in place for developing staff within firms. One of the things that the senior managers and certification regime was intended to do, as it was originally proposed by the Parliamentary Commission, was to just radically change the standard of behaviour within banking by implementing new rules, but also holding people more closely to account for the standard of their behaviour. But what we're seeing in some quarters is that where certification staff are concerned, people are very unwilling to identify development points for them when it comes to their annual appraisal. And there are quite good reasons for that within the structure of this new regime. The person managing the certification staff member doesn't want to get to the point where a year later they have development points which are still open, which can't be closed off, because then that makes it more difficult for them to decide that this person is fit and proper on the competence and capability ground to carry on in their role. Equally, the senior management function holder who's responsible for embedding the certification regime and the firm operating that side of the regime properly is going to have difficulty signing off, possibly on a fitness and propriety assessment of somebody who's got significant outstanding development points. All of these things, I think, are eminently fixable by clearer regulatory guidance, again, towards senior management on how you manage development points for certification staff. And the regulators in other contexts are very, very vocal at the moment about performance management and how important it is to be assessing people according to qualitative measures and how they behave rather than just are they hitting their number targets. But it seems to me that in the same breath they're making it more difficult for senior managers to do that in respect of certification staff because of this lack of guidance around what you can and can't do with certification staff at the annual certification deadline, where they have open development points that they haven't been able to close down completely. And thirdly, I said I'd come back to it, but I do want to come back to whistleblowing. The quantity of whistleblowing incidents reported to the FCA is up. There was a Freedom of Information Act disclosure by the FCA a few months ago, which revealed that the numbers are up 20% from 2016 to 2017. But that's not the only thing that those disclosures tell us. They also tell us that the quality of the disclosure seems to be going in the opposite direction. So what the FCA has done in the disclosure that I mentioned is to set out both the numbers and also categorised the disclosures into essentially 4 quality buckets, where the first 2 are sort of already useful or likely to be useful, and the other 2 are not useful at the moment, we're not sure, or definitely not useful. And if you run the stats on the percentage that were useful as opposed to not useful, you see that in 2016 they found 35% of their whistleblowing disclosures useful, and in 2017 they found 13% useful. And I was struck by that because it mirrors what I'm seeing in my practice, that you do see more and more people coming out of the woodwork under SMCR with whistleblowing disclosures to make. But a lot of them, when you dig even slightly, there just really isn't anything in them. And it makes me concerned that actually this accountability regime, which was designed to improve the standard of conduct in banking, is driving a different behaviour, which is defensiveness. And particularly a lot of the whistleblowers I see as senior management function holders. And where the Parliamentary Commission would want to see them taking control of their area of the business and owning that and working hard to improve standards of conduct. What I'm seeing as well, I'm not going to say instead, but certainly as well, is a certain amount of pointing the finger at someone else and running in the other direction and saying, can you please fix this, because I'm worried. That's not what was intended, is it? That's probably the opposite of what was intended. Please don't hear me wrongly. I totally understand and appreciate that there are lots of reasons why senior managers and anybody would need to blow the whistle and would need to go through that perfectly very important framework that has been put in under senior managers regime to enable that. The whistleblowing framework is important, but it's also important that it be used effectively and responsibly. And I fear that the defensive mindset that is being created in some quarters by the worry about personal accountability is driving unwelcome behaviours. I don't know if you had any thoughts on that one.
No, I guess, yes, clearly that's a potential consequence. I guess it would be interesting to know how many of those whistleblowers had blown the whistle internally first, because in theory that should be their first route.
Yeah.
I must say I'm not an expert on the FCA whistleblowing mechanism, but I don't know if they ask that question.
No, I don't know whether they do.
Have you sort of blown the whistle internally first? Because I would have thought if the answer is no, that it should be a sort of, return to step 1 and try internally first sort of thing, rather than it going to the FCA. Because that, that then, if you're not willing to declare it internally, you shouldn't really CYA by going to the regulator.
Mm-hmm.
Yeah, that's a good point.
Oh.
I have seen, sorry.
No, I was just going to ask Adam, because the second point you raised, which I find a very odd unintended consequence of the regulation, which is on the development of individuals, right? And I mean, you want people to develop, right? But you can see why writing that down and then a year later, maybe things haven't incrementally improved and et cetera. Does State Street also see that as
I mean, maybe we're naive, but I haven't seen that. I guess the one thing I'd say there is that, if they're fit and proper for the role at the moment, then the development needs shouldn't be so material that they can't have set development needs. Because if the development needs are so material that they're not fit and proper now, then don't mark them as fit and proper now. Get them to develop and then move them into a fit and proper role. So I guess it's almost similar to the whistleblowing in that it's a slightly sort of, negative approach to it, looking for the worst case scenario where they don't meet those needs. And so, but if they don't meet those needs, it shouldn't stop you marking them fit and proper in a year's time, because you're marking them as fit and proper now. So I guess partly it's the sort of, it's taking that balanced view. And again, when it comes up to the senior manager, ultimately the proof is in the pudding, but it's about reasonable steps. And as long as there's reasonable steps that that your teams set the right objectives, followed through with them, maybe didn't meet all of them, but made the judgment at the end of it, then the theory is that you should be okay.
So I'm mindful of the time, and I want you guys to have an opportunity to ask both Polly and Adam questions, but I think it'd be good for you guys to touch on the culture aspect, the certification regime component of the senior management regime, if you want to kind of elaborate a bit on that, because I think that's, you were saying in our pre-call that that's probably the most challenging part for organizations with this regulation. Would you agree? Polly?
Yeah, I mean, partly because it's, there's very clear guidance on what senior managers you require. You have to have ones for each material business line, you have to have ones for compliance, for risk, etc. Whereas a certification regime, there's more guidance. There's no clear cut, this person should be certified, this person shouldn't. So there is a certain amount of judgment required there. And obviously it's that balance between, not everyone should be certified. There's an admin around certification, but also it provides senior management with a certain amount of extra protection because there's a higher standard for the people who are certified than for everybody else in that triangle that Polly referred to. But it's sort of extra work and extra judgment. So it is a balance there. So I think that's why for an organisation it does create, it's something that we review every year is like, let's look at our total certification population. Is this the right population? Are there some individuals in here that should or shouldn't be? And the other challenge is that there's then remuneration regimes in Europe. And there's a sort of, there's a sort of almost not disconnect, but, if someone's caught by the remuneration regime, does that mean they should be certified as well, and vice versa? And so there's an extra layer of bureaucracy, judgment, admin there to be thought of as well.
And do you see the HR team getting involved in working with compliance and legal in terms of developing performance programs or learning programs around this? Yes, we do. I mean, HR own our learning program, and so in terms of the learnings, there's different learning modules for everybody, for those who are certified, for those who are senior managers, to make sure they fully understand. That's sort of, I suppose, the subject matter experts are the compliance team and the senior manager regime office, but HR deploy it. But also, I think, yes, in terms of making sure, being a global organisation, it's more making sure that the global performance programme meets the needs so that the managers can sort of make a judgment on fitness and propriety. But then it is the senior manager's office that basically implemented the regime that manage that annual certification that Polly referred to, outside the normal HR review cycle. But nevertheless, it references that your sort of review of your team should be considered. Clearly, you shouldn't be signing somebody off if you've got loads of negative feedback in their annual appraisal and vice versa. Polly, did you want to comment on some of the conflicts you've seen with SMCR and employment contracts?
Sure. So when I do investigations work, typically I'm working alongside an employment lawyer because probably the thing will have come up in the first place from a whistleblower, and there'll be sort of the regulatory team led by me and the employment lawyers all responding to the same disclosure. And we often experience a tension between what the firm ought to do from a regulatory perspective and what the firm ought to do from a minimising the employment risk perspective. Typically my experience is that firms where there's somebody being vocal, raising points, making themselves unpopular often, firms' preference would be to settle that person out quickly, would be to sort of fix that problem from a business as usual perspective as soon as possible. But that conflicts with what the regime requires, and particularly what senior managers are required to think about in terms of making sure that where a regulatory issue has been raised, that's investigated thoroughly and dealt with in an open-minded way, rather than just trying to sort of move the person to the side. Other issues that arise in that context are to do with regulatory notification, so particularly where an issue that is discovered that might be a conduct rule breach or might be a fitness and propriety issue under the regime, there are certain regulatory notification duties that the firm has to think about to comply with its regulatory duties, but those will often conflict with what the firm would like to do on an employment law basis to make sure they're being fair to the individual concerned. So if you say something unfair to a regulator about somebody's behaviour, that can give rise to employment claims later down the same track. So I think that a positive result of this new regime is that it forces HR practitioners and compliance and legal experts to collaborate more than they've ever had to in the past and think about risk in a much more holistic way and actually identify, right, what are the regulatory risks of this course of action, what are the employment related risks, and actually just weigh it up I have to say that often I win, and it's the regulatory risk consideration that trumps the employment law risk. But it is important, I think, to a proper risk assessment process to be thinking about each of those categories of risks specifically together, and weigh them up and then decide what to do. And I think that just makes sense from a risk management perspective. I think it's an improvement.
And to make sure all of that is recorded, because for example, if in the circumstance that Polly doesn't win, for want of a better word, if it then means that, let's say, nothing goes on the record of that individual, if there's because what happens is if the individual is certified and they move, then your employer will come to their previous employer for a regulatory reference. Now, if they don't refer to this activity or this investigation in that reference, and then something untoward happens with the employer in the future, it might then be something that's followed up on by the regulator or somebody else. So recording the decision and making sure that it's sort of documented clearly, I think, is important.
Absolutely.
So we have 10 minutes left. Are there any questions for Adam or Polly? Go ahead. Chris?
An obvious one. Can you think of areas, or the most prevalent areas, where firms or the people at firms are the most reluctant to obey the rules properly?
I don't think, well, the question was, in case you couldn't hear or for the recording, there are firms or areas of firms where people are most reluctant to obey the rules. I mean, I don't think so, because I think a lot of it comes down to the culture of the organisation as to whether, there is generally an approach to follow the rules, or there isn't. Going back to sort of various sort of statements on this in the past during LIBOR and FX, the reality is there are always some bad apples, but the culture determines, to coin the phrase, whether the whole barrel is sort of corrupted or whether it's a few bad apples in the barrel, and a lot of people will have read that analogy from various regulators. So I don't think there are specific areas. I mean, clearly there are areas where the risks and rewards can be slightly outweighed, and this regime tries to offset that, because ultimately in banks you have risk managers, and so if the risk manager, let's say on a trading desk, works out that the upside is, let's say, $1 million for them, and the downside is a fine of 50,000, and the probability of the fine is fairly small, then if the sort of culture is a certain way, it can influence their decision. So clearly there can be a misweighting, but what you'll see is it's surprising the number of cases of misconduct where it was more about the organisation benefiting and the person's bonus wasn't necessarily impacted as significantly as one might expect. It was more about making sure that they met their objectives, and hence they kept their job, if you sort of read between the lines. And hence that applies across an organisation. It's not specific to the trading floor, where one often thinks that this might always occur.
Go ahead.
There's a lot of talk in the regulations about reasonable judgment and doing the right thing given the information available at the time. How willing do we believe, or are we seeing the regulator to be to use hindsight in deciding whether or not you're being reasonable and taking all the appropriate steps?
I'll take that one from the defence perspective. I think that hindsight is a tool that the regulator uses a lot. I've never defended anybody where I haven't felt that hindsight was being used unfairly against my client. It's a point that we always make. It's a point that doesn't ever succeed in changing their position. And so really the only solution to that is to take notes. This is probably, to answer your question, the thing that I get most pushback on when I go into boardrooms and talk about this new regime and what it requires. People hate to be told, actually, you have to take notes of what factors you considered when you were making an important management decision, and you have to then put that note somewhere where you know you're going to be able to find it again, or someone in your compliance team will be able to find it for 6 years after you've left. Because it is, in my experience, it's an insurmountable temptation to them to exercise hindsight. And the world does look different, doesn't it, through perfect 2020 hindsight. It's not something that I expect to change, notwithstanding all the rhetoric that comes out of particularly the FCA about wanting to keep an open mind at the investigation stage, and the fact that an investigation's being open, not indicating that there's any sort of prejudged outcome, that is a work in progress. And my experience is that there is often an agenda when you find yourself in a tense regulatory situation, and you have to assume that hindsight will be used against you. So I'm sure you have some ideas about how you document reasonable steps, but I just can't overestimate how important that is, that where there are senior managers who you're supporting, or if you're a senior manager yourself, that you make sure that the thought process by which a decision is made is documented. It doesn't have to turn out to be the best decision to keep you safe. It just needs to be evident to somebody coming back and looking at your notes that you had a reasonable and logical basis for making that decision. Then it's not on you if it turns out that events moved against you, but you do have to be able to show what was in your mind and that was a sensible course of action.
No, I'd agree with that. I mean, I think, historically, I just, as a personal perspective, historically, have written notes in notebooks. I don't do that anymore. Now, I stopped doing that before I became a senior manager, but I take all my notes in the sort of notes application that comes with Outlook, because then I can have the date and the sort of meeting that it refers to, whether it's a one-on-one or a sort of committee meeting or whatever, and all my notes are in there, because then they're searchable. They're they're easily stored. I can access them on my phone, on my iPad, on my computer, and so they're at my sort of fingertips if and when I need them, not just for my sort of regulatory responsibilities, but more generally. So I do think, it puts an extra sort of onus on making sure your notes are secure, easily accessible, and to a certain extent easily searchable. Because if it's 5 years later, which of the 10 sort of notebooks you have, and where to find it in that notebook, and what your scribbles actually mean, is maybe sort of more challenging than it needed to be.
Might I add something, please?
Mm-hmm.
Is it true, I think it is, that there is no such thing as jurisprudence or precedent on the upper tribunal? So there's no way that they can gradually, step by step, build up a picture of what reasonable looks like. Is that right?
The problem is that sorry, let me repeat the question. The question for the tape was, is it true that there's no such thing as jurisprudence for the tribunal, so you can't expect to see a body of case law gradually building up over time as to what reasonable steps look like? The real problem is that nobody goes there, because everybody settles their FCA and PRA enforcement cases early. There's a huge source of frustration to me, defence side, because often even when people could win, they just can't face this. They look at 4 years ahead of them of fighting this thing, and often an uncooperative D&O insurer and or an employer who's getting a bit tired of paying their legal bills and is very, very keen to encourage them to settle. And added to that, to all of the human reasons why people might not want to continue to be on the receiving end of something like that. Very, very few people go there.
So nobody knows.
So nobody knows, and there is a lack of guidance, I think, on the reasonable steps framework. There is some useful guidance recently published by the FCA, but hidden away in a section of the FCA handbook called DEP, which is the Decision Making and Enforcement Penalties section, which is supposed to be relevant to when the regulator will and won't bring disciplinary action against someone. That the most helpful guidance on reasonable steps that I've found from the regulators is in there, and it says some useful things. So, for example, it says, following the Pottage decision a few years ago, it now says clearly in the FCA guidance that a new senior manager coming into role for the first time must carry out an initial assessment of the risk management framework in their area of the business, and must document that and show the regulators who might be asking later that they have thought about whether the risk management framework is adequate. So useful snippets in there, but I totally agree with you, Chris, that there is an unfortunate lack of clear guidance on what it is and what it isn't.
Well, time's up. This has been a great session, so thank you, Polly, and thank you, Adam, for your time. And obviously they're still going to be around here for a while, so if you want to grab them and have a one-on-one conversation, please do. Thank you, guys.
Thank you.